Hello everyone and welcome back to the channel. In this video, we are tackling a scenario that terrifies most retail investors, but actually makes professional fund managers rub their hands together. The scenario is the flat market. Imagine a year where the Nifty starts at 25,800 and ends the year exactly at 26,000. That is effectively a 0% return. Most people assume that if the index goes nowhere, their portfolio goes nowhere. They think they've wasted a year. But what if we told you that in a completely flat market, your active mutual fund could still generate a solid 12% return? It sounds mathematically impossible, but it isn't. It's called volatility harvesting, and it is the secret engine of wealth creation that nobody talks about. Let's break it down. 1. The optical illusion. First, let's look at the illusion of a flat market. When you see a line chart of the Nifty that looks flat for a year, it doesn't mean the market stood still. It means the market went up and down violently but happened to end at the same spot. It might have crashed to 24,000, rallied to 27,000, and finally settled at 26,000. To a passive investor buying an index ETF, this volatility is just noise. They bought at the start and sold at the finish, so they made nothing. But to an active fund manager, this volatility is the raw material for profit. 2. The supermarket sale. Think of it like a supermarket sale. When the price of your favorite high-quality coffee drops from 500 rupees to 400 rupees, do you panic? No. You buy more packets because you are getting more value for your money. An active fund manager does the exact same thing. When the market dips due to panic or bad news, the index shrinks. But your fund manager is sitting on a pile of cash and fresh monthly SIPP inflows. He uses that dip to go shopping. He buys more shares of high-quality companies like HDFC Bank or Trent at a discount. 3. The magic math. Here is the math behind the magic. Suppose your fund owns a stock priced at Rs 100. The market crashes and the price drops to Rs 90. The passive index just sits there and takes the loss. But your active manager uses his cash reserves to buy more units at Rs 90. He is aggressively lowering the average cost of your portfolio. Now, imagine the market recovers and the price goes back to Rs 100. The index is back to square one, 0% gain, but your portfolio is now in profit. Why? Because you now own more units of the stock than you did at the start, and you bought those extra units at a cheaper price. The market didn't move an inch from start to finish, but your manager manufactured a profit simply by trading the volatility in between. 4. The dog and the man. This brings us to the second reason you win while the index sleeps. Earnings growth. Imagine a man walking a dog on a leash. The man represents the earnings, the actual profits of the companies. The dog represents the stock price. In the short term, the dog runs all over the place. It gets scared by loud noises, like US inflation data or war news, and runs backward even though the man is walking forward. Right now, the Nifty might look flat because the dog is scared. But the companies in your mid-cap portfolio are actually growing their profits by 20% every year. Eventually, the dog has to catch up to the man. It is a law of financial physics. Even if sentiment stays weak for 6 months, stock prices eventually have to rise to match those higher profits. This is how your portfolio decouples from the Nifty. While the index is dragged down by slow sectors, your manager is holding the winners. So the next time you see the Nifty stuck in a range for months, do not get bored and stop your SIPPs. That flat line is not a dead end. It is a construction zone. Your fund manager is busy on the shop floor, using every dip to upgrade your portfolio and buy more units at lower prices. He is compressing a spring that will expand massively when the sentiment finally turns. You don't need the Nifty to go to 30,000 to make money. You just need to stay invested and let the volatility work in your favor. If you found this explanation helpful, please hit that like button and subscribe to the channel for more no-nonsense financial wisdom. Thanks for watching and see you in the next video.